Economist here. So, a lot of people are of the mindset that the Federal Reserve is going to be forced to cut rates. Now, I find this to be a very interesting statement, and I ask the question a lot of times, why is the Federal Reserve going to be forced to cut rates? And, many times I'll get this reply, they're doing it for the election, they want to help out the Democrats or something of that nature. Or they'll say, like, they want to make sure that the rich elitists continue to be rich and elite and, separate the rich from the poor, that kind of thing going on. There's this idea that the Federal Reserve is doing it for reasons that are outside of their dual mandate. Like, I look at the dual mandate of the Federal Reserve. They are mandated to do two things, just two. They're not mandated to make sure the administration stays in office. They're not mandated to make sure the housing market stays elevated. They're not mandated to make sure that the rich elitists stay rich and elite. They're mandated to have low inflation with stable prices and full employment. Now, I will, admit and grant it to you that the conditions in which that the Federal Reserve operates in does give the ability to separate the rich from the poor. The people out there who recognize what it is that's taken place can position themselves for that, to separate themselves from the poor. And now, as that continues, a lot of people will get frustrated with the Federal Reserve, with the government, with the things that are going on out there, saying, hey, this is unfair, this isn't right, it should be a different way. They have all these, like, what I feel maybe reasonable excuses and, problems that are now occurring because of the situation that the Federal Reserve is dealing with. Now, granted, I'm not here trying to tell you that the Federal Reserve is doing good or bad. They're just doing it. They're just conducting themselves as they feel is most appropriate for their monetary policy, which is low inflation with stable prices and full employment. So I think about the dual mandate when it comes to monetary policies, because again, a lot of times people will look at monetary policy and thinking that the government is involved with monetary policy. They're not. The government is fiscal policy. They deal with the spending and the stimulus programs and the taxing and all that other stuff. That doesn't have anything to do with the Federal Reserve. The Federal Reserve is in charge of finance, the financial system, the banking system. Like, adjusting of interest rates has everything to do with the financial system. It doesn't really have anything to do with the government and their taxing and their stimulus packages or anything else like that. Now, granted, again, if you look at it, when the Federal Reserve is buying bonds, the government is generally spending, which means that they're issuing bonds. So as the government is spending money and issuing bonds, the Federal Reserve is generally there to buy those to ease the conditions in which that the government is now spending their money at. Right? Does that all kind of make sense? So a lot of times people put these two together and say, no, that's a single entity doing that. It's not. Right? Again, we have to think about how it is that the Federal Reserve is operating, because the Federal Reserve can't go directly to the Treasury and buy those bonds. They have to buy them from the secondary market, which means that the bonds that the Federal Reserve is purchasing has already been purchased by the market itself. So the Federal Reserve is operating in the markets, not operating with the government. And again, if the big banking system that is out there, the JP Morgans, Goldman Sachs, the primary dealers, if they know that the Federal Reserve is going to be there, right, they're going to be there to buy those bonds, then it gives them a position in which that they can just openly buy these treasuries with very little concern that they won't have somebody to sell them to, considering the Federal Reserve is there. But understanding that all that is not a necessity. It is not required of the Federal Reserve to do that. They are operating in a way that tries to keep full employment and low inflation with stable prices. Now, because a lot of people will recognize that and then position themselves to profit wildly on account of it, doesn't necessarily mean that the Federal Reserve is doing it on purpose. That's important to understand. We can position ourselves to take advantage of it too, if you know that it's coming, if you recognize the monetary policy coming from the Federal Reserve itself. Now, again, if you don't recognize the monetary policy in the way that the Federal Reserve is conducting themselves, but more in an assumption that it's for government purposes, it's for the rich elitist, it's for, the corporations, it's all about greed. If that's the position that you take, you'll never, ever, 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 ever be able to see how the monetary policy is truly conducted from the Federal Reserve, because you have already got your beliefs confirmed on what it is. And it's a manipulation, it's conspiracy theory, it's all this stuff that's happening out there, which, a lot of it probably is true, but it's not the underlying reasoning that's happening out there. The underlying position that the Federal Reserve is taking is the fact that they had run out of monetary policy with the adjustment of rates. This is important to understand, because a lot of times when I talk about monetary policy, the very first question that people will ask of me, are they going to cut? Right? How much are they going to cut? How many times are they going to cut? They have this focus on the interest rate and the cutting of interest rates, and believe that the markets are forcing the Federal Reserve to do that, or that the government is doing that, right? That there is some sort of like higher power of manipulation that is now being conducted over the Federal Reserve to now position like the interest rates to be the most profitable for the rich elitists and the corporations, and the most damaging for the people. This is like, again, a very common narrative that you will hear out there. But ultimately, the Federal Reserve was in a position in which that they couldn't even stimulate the economy anyway. They literally had no more room to adjust interest rates to stimulate the economy. And this was many years ago. Like, we're talking the Great Financial Crisis 2008 timeline. So we're going on like almost 20 years, 14, 15 years of monetary policy that the interest rate adjustments was no longer the effective tool. But yet nobody sees that. And that is how the Federal Reserve is able to how they were able to conduct themselves in the way that they are, is because most people don't realize that they ran out of monetary policy. They ran out of the ability to adjust interest rates, and they knew this was coming. And so they positioned the economy to then listen to their words. This is important to understand, because each and every single one of us is the economy. We're an economy individually by ourselves, making our decision. As we make these decisions together, as a whole, it forms the entire economy. Now, just because the Federal Reserve positions interest rates at a certain area doesn't necessarily impact the entire economy the same way. We may have positioned ourselves to take advantage of that, knowing that it was coming. Some other people are going to get incredibly hurt by it, as the added interest rates that are elevated start slowing down business. It makes it more difficult to service loans. It has all these issues that people are facing, and they say, hey man, this is pain. This is pain and misery that I'm experiencing from these elevated interest rates. And then there's another group of people out there who are saying, hell no. This is the best thing ever. I am making a killing off these interest rates. Considering where they were before, my savings is actually having some sort of decent return to it now. I don't know about decent, but better, right? And so again, there is two different economies that are taking place at the same time, when you consider some people have positioned themselves accordingly to deal with higher interest rates, and other people are getting damaged by it. So the people who are getting damaged by it, or the people who are not finding this to be the most appropriate place for the economy, for the interest rates to be to deal with their particular economy, they have a tendency to blame or believe that there is a forced situation here that is creating that. Again, if you just step back for just a minute, right? Take all this narrative, all this, misunderstanding, all this confusion about what it is that's taken place, and you set that aside for just a second and say, okay, what is it that the Federal Reserve is really facing, right? What they are facing was the fact that the Fed funds rate had hit the lower bound of zero. Understand that for just a moment, that moment ended the Federal Reserve in the adjustment of interest rates to stimulate the economy. It just wasn't going to work anymore. And they knew it. They knew this was coming. And since they knew it was coming, they developed tools to deal with the fact that the lower bound was going to be hit when the Fed funds rate achieved zero. That was done. They knew their words was going to be the only tool that was really going to have any kind of effective positioning or anything to the economy. It was their words. And now mainly the problem that they were facing was an inflation expectation that was too low. An inflation expectation that was persistently too low. And the moment that we all had the inflationary scenario that was going to destroy the world, the Federal Reserve was gaining their ammo back. It was one of the most incredible gaslightings of history that still nobody sees. And yet they are pushing a narrative, a belief that is benefiting the Federal Reserve. Every time we hear inflation is going to destroy you, that is going to run rampant, that is going to, end the dollar weakness, all this stuff, all that was a benefit to the Federal Reserve. The higher the inflation expectation went, the more that they could raise the Fed funds rate and get that Fed funds rate far enough above zero to then try and actually raise what they refer to as the neutral interest rate. And now, again, this is very difficult for a lot of people to wrap their heads around, especially those who have convinced themselves that it's a political move. If you believe it's a political move, if you think it's for the rich elitist, if you think that it's all about, keeping the poor, then you will never, ever see this. You will not be able to recognize the monetary policy because you have already got your confirmation set in stone. But the moment that you do recognize it, that the neutral interest rate, which is the rate that the Fed funds rate is neither accommodating nor restricting the economy, when you see that neutral interest rate was very close to zero, and in order for the Federal Reserve to stimulate the economy, they have to drop significantly below that neutral interest rate. But if they hit the lower bound at zero, it's done. It's not going to work. If you can understand that, it's not a political environment that created that. It was a long, drawn-out condition in which that neutral interest rate continuously fell. It fell on low inflation expectations. If you think about all the quantitative easing, 1, 2, 3, and 4, the expansion of the Fed's balance sheet from $850 billion to over $4.5 trillion failed to produce an inflationary scenario that the Federal Reserve was looking for. Now, we can go and say, oh, look at houses, look at, the stock market, look at the bond, look at all this stuff that the interest rates went up on. Well, let's understand why it is that those particular assets went up in price. Think about who has access to the money first. See, if you have quantitative easing 1, 2, 3, and 4 swelling up the big bank's balance sheet, but it's sitting on the big bank's balance sheet and not actually entering into the economy, how is it that all that money printing starts chasing the goods and services? It doesn't. It sits at the big bank's balance sheets and never actually enters into the economy. How does that money enter into the economy? You borrow it into the economy. So people who had first access to these incredibly cheap interest rate loans that the big banks were offering are the people who had first access. What were they buying? They were buying houses. They were buying stock market. They were buying into the things that you borrow money to buy. Generally, you don't borrow money to go buy toothpaste. You don't borrow money to go, like some people will, right? But for the general population out there, you don't borrow that money to go and have your normal necessities of life. And again, like some people will, but generally speaking, that's not the case. And if you have an inflation expectation that is remaining low, then you have no panic situation in which that you would run out there and buy those items before they went up in price. You would just assume that next week they're probably going to be somewhat similar to the prices that you had experienced the week before. And now again, after quantitative easing 1, 2, 3, and 4, swelling of the balance sheet from $850 billion to $4.5 trillion, but yet that money wasn't necessarily lent into the system in a profound way that created the inflationary scenario of everything rising. What does create the inflationary scenario of everything rising? Well, the COVID pandemic and the monetary policies and the fiscal policies coming from the Federal Reserve and the government started issuing out not only massive quantitative easing, right, very similar to what we had experienced during the Great Financial Crisis, but then the government did something very unique. that was different from the quantitative easings 1, 2, 3, and 4. See, the great financial crisis, although it had stimulus and it had, some government spendings and fiscal policies and different things like that that went on that created the inflationary scenario that never really did manifest itself. This time around, the COVID pandemic shut down the economy. Don't go to work. Don't distribute. Don't manufacture. Don't show up for work. Well, what happens if you don't show up for work? Nothing is going to start moving. That means nothing new is going to get manufactured, the distribution will start to fall apart, and eventually inventory will be depleted, especially if you are handed a stimulus check and that says, hey, go out there and clear out all them shelves. And by the way, we're going to put a block on the ability to have more coming through the system. What do you think about that, everybody within the economy? Holy moly, shortages. No ability to get it in the future. Lead times start to extend. Well, what do? We better buy it in a hurry. We better hurry up and buy it before it goes up in price. All of a sudden, you have an elevated inflation expectation that starts running rampant through the economy. People start behaving in a way as if the inflation is going to be permanent. See, we had quantitative easing 1, 2, 3, and 4, and people had the inflation expectation elevated, which did work for a moment. It was a flash in the pan. Unless you had actually severed the supply chain and created the spending opportunity by issuing out stimulus checks, there was no way that inflation was going to be permanent. In fact, severing the supply chain and handing out stimulus is still a temporary condition. Look at it now. The inflation is coming down and people are going, hey, inflation is down. How is this possible considering that the Federal Reserve has hardly done any tightening at all? I mean, it's a significant amount they pulled out, but considering how much they have printed over the last few years, there is no way that we should have inflation that has come back down to normal. If everybody is under the impression that money printer causing the inflation, then there should be still plenty of inflation around. It shouldn't be coming down. But yet here it is, it's taken place. Why? Because the money printer doesn't necessarily cause inflation. What causes inflation, price inflation, is added consumption. It is so important to understand that it's the added consumption that drives the inflationary scenario. And if you don't see it that way, you are going to be stuck with the idea that it's the government's fault, it's the money printer fault, it's all this stuff, but yet really the underlying force that has taken place is that the people who had first access to the money will spend it at face value, and they will then increase that consumption, which deprives the rest of the economy the ability to buy into that particular item, whether it's houses or cars or anything else out there. So think about it again. Inflation is that which is added consumption. People who have first access to the money will then spend that money at face value, raising the consumption and causing the separation between the rich and the poor, because the inflated prices are coming due to the imbalance of supply and demand. See, all the money printing back in quantitative easing 1, 2, 3, and 4 failed to produce the inflationary scenario. We have to understand why. Right? It's easy enough to say they lied. All right? Done. Don't need to understand monetary policy after that. They lied. That's all there is to it. Well, if that's the case, then what are you going to understand for the future? How are you going to position yourself? You're going to position yourself off of the idea that they are liars. How do you do that? How do you position yourself with that? It's very difficult, because all you're going to see is lies being told out there. And if everything on the external is a lie, how do you deal with the internal? Like, you can't. You will always be stuck at the whim of the narrative. What's next? What are they talking about? Who is it? Why? If you go and you start researching the monetary policy for yourself, you're going to start seeing that the monetary policy is very well articulated out there to the other central bankers. It is not clearly communicated to the mainstream media. It's not clearly communicated through the other economists, and it's hardly communicated through the Federal Reserve when they are doing interviews or anything that's being addressed to the mainstream media. They just don't do it. And in fact, when people are misunderstanding the monetary policy, such as that of a 2% target. When they hear 2% target, or that the Federal Reserve is going for a 2% target, the Federal Reserve doesn't correct it. They don't say, hey, no, we're not. We're not doing that. We're actually going for a flexible average inflation rate over time, which means that appropriate monetary policy would seek to achieve an inflation rate that is moderately above 2% for some time. They do not clarify it like that. But that is the truth. The truth of it is that they shoot for a monetary policy that is moderately above 2% for some time, because they are in what they refer to as makeup strategies. Don't believe it? Go look it up. Federal Reserve makeup strategies. Go research it for yourself. It is very confusing. It is very long. It's complicated in so many ways. And if you haven't been following the credible threat theory that I feel is the true monetary policy coming from the Federal Reserve, if you're not following the credible threat theory, which I believe I'm the only one who communicates, if you're not following the credible threat theory, you're missing it. You are missing it. Go back to Ben Bernanke's speech talking about deflation and how to prevent it from ever recurring here. Listen to his concerns about how it is to prevent deflation. And then the day that it does happen, and that the Federal Reserve is no longer able to stimulate the economy because they have hit the lower bound of zero, look at the tools that he is describing to conduct the monetary policy coming out of the Federal Reserve. It comes down to a gold machine. The idea of a guy who invents a gold machine, a hypothetical situation. This is what he is saying is the main policy tool when you have no more room to adjust monetary policy through interest rates. He talks about this hypothetical gold machine that can produce as much gold at will with very little cost or energy. And the moment that this information gets out there to the public, out there to the markets, the price of gold would plummet immediately. And again, this hypothetical situation that Ben Bernanke was talking about is exactly what the Federal Reserve is now using today. This is how they conduct themselves. Here's the thing. Just over the last few weeks, since the Federal Reserve put out their statement that they are going to be cutting rates, which they didn't really say. They didn't say that. They said that appropriate monetary policy is coming into a condition in which that cutting rates would be the right position. They're saying it's getting there. It's becoming that. They didn't say it is that. They said it's becoming that. And so if the Federal Reserve was to recognize the situation in which that they are going to be cutting rates, they put out a statement like this and people believe it, then mainstream media narratives are saying, not if rate cuts. Is it going to be 25 basis points or 50 basis points? How many rate cuts? What is this going to do? Blah, 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 blah. But the Federal Reserve hasn't done anything yet. Look at the mortgage market. Look at the mortgages coming down with the anticipation of rate cuts. They didn't have to do anything. The Federal Reserve is sitting on their hands right now, and yet the mortgage market is already starting to ease. That is the credible threat that has taken place. That is not anything to do with the Federal Reserve making the accommodations easier to buy a house. It's not lowering the mortgage rates. They are not conducting themselves in a way that adjusts those mortgage rates. The market is doing that with the idea of what the Federal Reserve is going to do into the future. See, so many people are asking me, when are they going to cut rates? How are they going to cut rates? Cut rates, cuts rates, cuts rates. And I'm thinking that is not the important information. If that's what you have wrapped around your idea of the main focus of the Federal Reserve right now is not the threat of it, but the actual cutting of rates, you are missing the credible threat theory. You have missed it. And again, like I have explained credible threat so many times. I did a 10-minute video just recently trying to condense all the information that you would need into a 10-minute video so that you don't have to sit around for a 2-hour live stream to figure out what credible threats are. And yet still, I will find people after listening to that ask me, so are they going to cut rates next week? And it's just like, gosh, it's, again, that's the way that they used to conduct themselves. And because so many people are now focused in on that, they can't see it any other way. And then if you don't see that, you're blaming it on government, you're blaming it on greed, you're blaming it on corporations, you put all this other blame out there. to why it is that they are doing this, but ultimately what it comes down to is to understand that the adjustment of interest rates is not the effective tool. Even if they were to cut rates today, they cannot stimulate the economy. Understand that. There is no way cutting rates stimulates the economy. They would have to take it all the way to zero. The Fed funds rate would have to go to zero. And even at that, they would be just barely under neutral. So how in the world does how does the neutral interest rate being so low to the effective lower bound of zero give the Federal Reserve the ability to stimulate with interest rate cuts? They can't. They can't. Nobody knows that though. Nobody recognizes it. Nobody speaks of that. There's not a single economist out there. The Fed doesn't clarify it. Nobody. Like, I am literally the only one who continuously brings that up. Yeah, will it make markets less restrictive if they lower rates? Sure. And could the neutral interest rate rise, making the Fed funds rate position, if they were to stand still, less restrictive if the neutral interest rate rises? Yeah. But no matter how you look at it right now, even if the Fed was to cut 2, even 3 basis points, if they were to cut 3 entire percentage points, 300 basis points, okay, they would still be above the neutral interest rate, and it would still be a restrictive position from the Federal Reserve. So I have to ask again, what is it that the people are seeing out there in order to understand why the Federal Reserve would be cutting rates? They are mandated to do 2 things: low inflation with stable prices and full employment. Well, the inflation narrative is now coming down. Everybody seems to think that the inflation has now disappeared. Okay? And again, it's not prices coming down, it's inflation. That's the amount that the prices are moving up. That has come down. Disinflation or deflation, that would be disinflation as well. Deflation is when you actually see the prices coming down. That we are not experiencing deflation, not yet. It is still inflation. It is just a lot less inflation. That's what the Federal Reserve was looking for. They are positioning the economy in accordance to their dual mandate. And now again, I look at the weakening jobs market. This is a very big narrative that you hear out there. All the layoffs, all the stuff, everybody's crying, oh, the weak jobs market. Everybody's, concerned about the weak jobs market. Well, go and look at unemployment. Just type in unemployment, FRED, right? Look at the Federal Reserve's unemployment chart. And again, like I'm going to say, regardless of what you think about the Federal Reserve's information out there, we might see it differently. We might say unemployment's a hell of a lot higher. That's fine. It very well could be the truth. But that's not what the Federal Reserve is doing. The Federal Reserve is looking at these numbers, their numbers. And so if we want to know what the Federal Reserve is going to do with monetary policy, we have to look at what they're looking at. Right? We can say, hey, you need to look at this, you need to look at that, you need to understand it differently. Yeah, that very well could be true. That's not what they do. Right? And we can wish and hope and dream that they will look at those other numbers to say, hey, this is what you really need to look at. They don't. Right? And they're not going to. They're going to look at their numbers. And so we have to understand what their numbers are in accordance to what they view in order to understand what they are going to do with that monetary policy. How do we position ourselves in accordance to that? Unemployment is still historically low, like very, very low. And although it's much higher than what we had experienced over the last few years was not normal. It was not a normal thing to be in an economy in which that you saw so many help wanted signs with no workers available to go to them. That is not a normal position. And so as we see a 4.5% unemployment rate, a lot of people are very concerned. Look how high it's gone. It's way bad. All this other heartache and misery on account of this 4.5% unemployment rate. And I think to myself, it's not that bad. I remember when I was a kid, it was 6.5%, way worse than this. And they didn't talk about stimulating packages and stuff like that. You actually had to have a recessionary pressure taking place in order for the Federal Reserve to move. But then again, that was back in the day when interest rate adjustments actually stimulated the economy. They don't stimulate the economy anymore. So the Fed had to position themselves in a way that they can conduct their monetary policy through their words, through their statements. And this is, again, this is what we are facing today. Most people don't see it this way. And again, like if you don't, you're going to end up blaming political environments or corporate greed or, all this other stuff. And if you do that, you will find plenty of evidence out there, but yet you will not see the appropriate monetary policy. 400 people watching. Nice. Go hit that like button. We got a super chat. We're going to go check that out real quick. Half an hour into this live stream. Super chat says, Robert, $4.99. Thank you so much. As lumber production is decreasing, priorities maybe should go up, but is it at all-time low at Home Depot? Your thoughts? As lumber production decreases, is that prices maybe? Prices should go up, but it's all-time low at Home Depot. Your thoughts? Okay, prices will go up on demand, right? Just because supply falls doesn't mean that demand was elevated, right? If demand is falling with supply, then why would there be increases? Supply-demand imbalances. This is what causes prices to move. Just, again, the reason why the mills are in curtailment and shutting down and depleting inventory is because there's not a lot of demand out there. And if there's not a lot of demand, then you're not going to see the prices move up, no matter how low the inventory goes. So if the demand and the inventory are falling together, the prices are going to stay stable, even though these two are moving dramatically. The moment that you have an imbalance of these two, that's when you're going to start seeing the prices move. So if you have a whole bunch of inventory and not a lot of demand, you'll see those prices at Home Depot fall even further. But that's not what's taking place right now. Inventory is really low and the demand is really low as well. Comparatively, I know a lot of, I try to put these videos out and it's sad on TikTok. TikTok is by far the worst place that I can put information out there on the internet, because it's in these short little videos that doesn't have a whole lot of context to it, and people take this short little part and they just tear it up, right? And I'm thinking, man, if you watched an entire video of mine, it would explain so much to these people. But when I look out there at what lumber demand is seeking right now, it's very low, right? Permit issuance is low. New housing starts are low comparatively to where they've been over the last few years. That's where I'm kind of getting at. They're higher than they were back in 2018. Right? But again, the amount of production that was taking place from these mills has definitely changed over the last few years. There was a huge shift from the British Columbia area down to the southern part of the United States. This mill operation shift is going to have a profound impact on the economy. It's not going to go back to operating the way that we had expected prior to the pandemic. We're not in the same environment anymore. It doesn't operate that way like it used to. So we have to adapt to this new situation to understand that the mill operations are going to be more prevalent down in the southern part of the United States, where there's a glut of pine tree plantations that the mills are going to try and take advantage of. Right? I mean, you think about it. If you were a fisherman who fishes, are you going to fish where there's a depletion of fish, or are you going to fish where there's an abundance of fish? Right? It's the same thing. It doesn't matter if you're a mill or if you're a fisherman, right? You go to where it's going to be most productive. And that's what we're experiencing right now, is this shift that has taken place. I believe, and I don't know if this is still the case, because there's been a lot of mill curtailments and operation shutdowns, but if I remember right, Interfor, which is a Canadian-based company, had more mills operating in the United States than they had operating in Canada. Right? That's a huge shift, right? That's taken place. So when the dust settles, and it might take years, it might take 10 years to understand where the lumber market is truly finding its position in order to find this, oversupply to undersupply to oversupply, again, this bullwhip effect. It may take an entire decade. I don't know. It may happen in 5 years. But I would assume that it's going to take many, many years in order to find that equilibrium. And again, it all comes down to supply and demand. All right. Holy crap, it's already noon. Oh my gosh, okay. Well, guys, I started a little late, so I gots to go, but it was a lot of fun hanging out with you guys, talking about monetary policy theories, and I'm going to keep pushing the credible threat theory. This is, it's what I feel is the most accurate monetary policy theory that is out there right now. I mean, I've been working on and developing this over years. I've researched it and pulled out documents and speeches dating 20 years ago showing how this is being developed and built up over the years. I've, broken down the communication styles that have now shifted in order to facilitate the credible threat theory. To me, it is by far the most accurate way of understanding the Federal Reserve and their strategies than any other thing out there, especially those who are blaming politics. Those who say that the Federal Reserve is conducting themselves this way for administration purposes, try to get this particular election covered or whatever, those are probably the farthest from being able to see the true monetary policy. I'm serious. They are probably the farthest away from being able to see it. Uneducated economist, you guys let me know.